Welcome to the Kapital News. I am your host, Alex Karitis. Today is Thursday, January 21st, 2021. Thank you so much for joining me. Title of today's podcast, Jobs Bite the Dust Again. Being Thursday, we're going to go through our weekly report with initial jobless claims, the Federal Reserve's balance sheet, a look at M1 and M2 money stock, and of course some market performance. So another tragic and heartbreaking initial jobless claims report was released this morning. Another 900,000 Americans filed an initial claim. We will get to that momentarily, but first I do want to get market performance out of the way. Now, of course, as we have been stating here for quite a while, bad news is good news, horrible news is great news, and Wall Street and the stock market, you get this type of information. You have 960-some thousand filing claims last week, or 2 weeks ago, I should say. Now we have 900,000, and the markets just go up. This is good news to the markets because this means that the Federal Reserve is going to have to print more money, that Congress is going to have to spend more money, borrow more money, beg for more money. This is not how you run an economy. This is how you destroy an economy. But we have the dollar index trading at 90.11 right now. Not too much movement overnight right now as we're doing this podcast with respect to some other currencies. However, Bitcoin was on a volatile ride to the downside, losing several percentage points. What was it, a week and a half ago? It was up at around 40,000. It is now trading at $31,100 per coin. Do what you want with these cryptocurrencies. That's your business. I think it's more of a fad, more of a bubble. I'm sure some of the technologies with respect to blockchain are here to stay. But hey, more power to you if you made out like a bandit trading it. But to me, that's all it is. It's just something. It's just a raid. It's just a wave to ride in these crazy times. When you see that type of volatility, it's not something I'm too fond of. Overnight futures trading, we have the Dow Jones Industrial Average down about 1/3%. S&P 500 is also in the red, down 1/4%. The NASDAQ 100 is also giving back 1/3%. We have a sea of red. I'm looking at just red across the board. Japanese cash trade is currently down 1/4%. Sea of red across the pond in Europe today, with the biggest losing markets in Europe being the Italian and Spanish markets, both giving back about 1%. And also down in cash trade in Australia, giving back about 0.4%. Now, we also have some of the PMI numbers. I know we've skipped over some of these recently, and I'm somewhat hesitant to go over them just because of the base effects that we've been dealing with because these numbers were so bad the prior year. But I just want to show sort of the disconnect, and typically you want to say, well, markets are supposed to be forward-looking, so why wasn't some of these figures already priced in? And so you have Japan services hitting its lowest number in 5 months. Japan services PMI the lowest in 5 months. You also have Japanese manufacturing shrinking again back into contraction with a number of 49.7. Anything below a reading of 50 is contraction. Anything above 50 is expansion. So again, Japanese manufacturing shrinking in the month of January, 49.7 on the preliminary figure. We also have Australian retail sales falling more than expected. And we also have Australian services PMI growth weakening. Still at a reading of 55.8, but weaker than the prior month. So still in expansion, but slowing down. So that might be why the markets are trading lower. But one would think that that should have been priced in. But everything, of course, is unexpected, right? Those are the key words, expected, unexpected. I don't know what these people are paying attention to. On the share price front, we have Apple putting on a nice gain of 3.7% for the day. Tesla giving back about 2/3%. Microsoft up about 1/4%. Amazon putting on a gain of 1.3%. And Facebook, to round out the big tech names, put on a gain of 2% for the day. On the commodity price front, general weakness today. We have crude oil, WTI, trading at $52.51. Brent at $55.50, and natural gas is trading at $2.48. Gold and silver were able to hold their own, but both are currently down in overnight trading. We have gold at $1,863 an ounce. Silver is giving back 1.5% currently, $25.57 per ounce. Again, those are spot prices. And to round it out, we have Uncle Sam's 10-year junk note yielding 1.11%. So that is some of the market performance. Keep you updated on that as we go along. So, Department of Labor initial jobless claims report for the week ending January 16th. 900,000 is the figure, as I stated at the top of the podcast. The prior week was revised downward, so we had two back-to-back reports with downward revisions, so we'll take that as a positive. And that figure was reduced to 926,000, which is still a staggering and heartbreaking figure, especially when we're told that everything's okay, we're in the middle of a miraculous V-shaped recovery, that the vaccines are here, everything's going to go back to normal, and this is what we continue to witness. And again, for some perspective, during the depths of the great financial crisis, we were talking about 650 to 670,000 initial jobless claims. Again, during the depths of the great financial crisis, the largest financial crisis since the Great Depression, 650,000 initial jobless claims. We have not seen 600,000 since last year, since going back to March of 2020. Yes, we've trended down. Yes, we went from millions to a million to 900,000, 800,000, some 700,000. We sort of stabilized, unfortunately, at those levels. Then we went back up to 8, and unfortunately for the past couple of weeks, we're back in the 900,000 range. That's because these problems are structural. They're not transitory by any stretch of the imagination. Continuing jobless claims for the week ending January 9th, it lags 1 week, comes in at 5 million, slightly above that, but we'll just round it to 5 million. That is a decrease from the prior week of 127,000. With respect to PUA, Pandemic Unemployment Assistance, for the week ending January 16th, we have 424,000. This is a week-over-week change of a positive 138,000. So more people getting back onto PUA, unfortunately. When we take everything together, regular state, federal employees, newly discharged veterans, PUA, PEUC, extended benefits, state additional benefits, and work share program, we get a grand total of 15.99 million. Let's call it 16 million. That is a decrease from the prior week of some 2.4 million. This would be for the week ending January 2nd. This figure lags by a couple of weeks. Now, this is what we want to see, obviously, but the question becomes, did these people get back to work? Did they find employment? Or was this simply because, well, the PUA and the PEUC expired? Now, of course, it was renewed and extended by the Trump administration with the Nobody Cares Act 2.0. Remember that $900 billion monstrosity, which was hitched to the wagon of a $1.4 trillion spending bill just to keep the lights on in this country for a few months. And this has not been a seamless transition of an extension, because this is the government and nothing is seamless and nothing runs perfectly with them, right? So the biggest contributing factors to this week-over-week decline came from pandemic unemployment assistance, with 1.8 million off of those rules. PEUC also had 1.1 million off of the rules. The largest increases came to regular state unemployment, 386,000, and extended benefits, gaining 82,500. So this really is the question that I have had from the beginning, going back to last March, April, when the Nobody Cares Act was passed and all this stuff came into existence. I said, these are distortionary effects. It's going to take a very long time for us to get a true picture of the jobs market. I mean, we know it's bad, and it's not going to be good anytime soon, but still, we would still like a clearer picture. So is this just because this was not a seamless transition for these extensions, and that's why so many people are off the rules with the PUA and the PEUC, or is this because people have found jobs? Now, I hope it's because people have found work or have gotten called back to work. But when we see 900,000 people filing initial jobless claims, you got to scratch your head and say, well, these numbers aren't quite necessarily adding up, are they? Because you have to remember, when we look at the official jobs report, which comes out the first Friday of the month, which we talked about here a couple of weeks ago, the surveys that are conducted to create the official jobs report typically take place in the middle of that month. So the Bureau of Labor Statistics is making phone calls during the middle of that month. Of course, the last month would have been December. Well, the figures that we continue to see here have been after that, 900,000 plus last week. For the past couple of weeks, that's 1.8 million. So is that simply just going to negate what we just witnessed over the past couple of weeks with respect to PUA? Or is this an accumulation? Because these people are still unemployed. This is why we have to go back and forth between all of these reports to try to make heads or tails as to what's going on out there. This is distortionary. These are structural. We are, however, seeing a rebound in employment with respect to higher wage earners, and that's a good thing. But that's also going to contribute to some of the new normal that we're going to have to deal with whenever this pandemic is over and the restrictions and lockdowns are lifted. Because the reason we are witnessing stronger rebounds in employment with respect to higher wage earners is because a lot of these people can work from home. They have that option. They have the ability. They can set up a home office. If they have a laptop or a desktop, maybe a tablet, and an internet connection, you're pretty much good to go. That's not the same for a lot of low-wage earners. You have to be at the hotel to offer the service. You have to be at the bar to make a drink. The waitress has to be at the restaurant, etc., etc. But you don't necessarily have to be at the office. And this has not just been a couple of months. We're going on a year with these business practices, with people working from home. So that's a lot of data. For managers to look at the data, crunch the numbers, and say, we are just as productive when we work from home and have a Skype or a Zoom conference call with each other. There's no reason for us to go back to the office, especially not 5 days a week. Maybe you're going to have to come in the office once or twice a week, what have you. But we don't need that much office space because we are not going to have 100% capacity. And on top of that, they continue to crunch the numbers. They might say, well, we used to have 10,000 employees, but guess what? Maybe we can cut a few thousand and be just as productive. That's what's going to continue to make the process. Go through the system. We've talked about this since last year, that these behaviors are going to change, how this is going to continue to hit commercial real estate because you just don't need that much space. Not going to need it. Well, what does that do down the line? If you're going to work every day, do you stop and get a donut somewhere? A bagel? A coffee? Is that a bigger corporation? Or is that a small mom and pop shop that you go to? Well, if you're not going every day, then you're no longer going there every day, most likely. Do you go out to lunch every day or every other day with your employees? Again, that could have been a big corporate place, or it could have been a small mom and pop shop where you went and got lunch every day. Well, if you're not at the office, you're probably not going to drive 20, 30, 40 minutes just to go get lunch there. You might do it every once in a while, assuming they're still in business. This new normal, these new behaviors still have not come to pass because there are still so many people working from home because, one, they like it. It's proving effective and productive for these businesses. And two, they're not allowed to go back to the office because of restrictions and lockdowns, what have you, depending on where they are. So we are far from out of this. The stock market, if you will, as they say, is priced to perfection, right? Everything has to go right in order for these prices to be justified. And with what's going on, I just don't know how we can possibly be at these levels other than the fact that this is a mania. It's out of control, and it's completely rigged and manipulated. This is all the result of low interest rates and money printing. Because all you have to ask yourself is, if you didn't have those two things, if you didn't have low interest rates, and if you didn't have all of this money printing, would the stock market be at these levels? And the answer is a resounding no. That's how simple it is. It's common sense, But people just want to continue to, look over here, look over there, put a shiny object here, pay attention to this, don't pay attention to that. Everything's fine, nothing to worry about. To me, it couldn't be further from the truth. We are in the midst of the greatest depression. A lot of people know it. Those facing eviction, those in food bank lines, those who are using credit cards to make ends meet. They know it. They know that this is the greatest depression. In a speech at the Capitol by the 46th President of the United States, while it might have been a nice speech, at the end of the day, it's not going to do much, unfortunately. Because that doesn't put food on the plate. That doesn't put money in the bank. And printing money is not a solution. Printing press can print money. It cannot print jobs. It cannot print a sound business plan. It cannot print solvency. But what it can do, in addition to printing dollars, is it can create zombie corporations, and it can maintain zombie corporations, which is devastating and destructive to current and future growth and prosperity. It saturates those opportunities, just takes them away so everything can look good today on paper, but not in reality. There is no free lunch. If it was that simple just to print money, and we'd never have any type of correction or any type of pullback in the markets or in the economy, then that's all they'd have to do. As soon as they saw some type of slippage, as soon as they saw some type of contraction, in whatever metric they wanted to use, whether it's GDP, whether it's the PMIs, whether it's a combination thereof, print money, boom, presto, that's it. End of story. It does not work like that. And we are in the midst of one of the greatest wealth transfers in human history. And that is not going to bode well politically or socially. And we're already seeing that as well. Federal Reserve's balance sheet came in at $7,414 billion. This is a new all-time high. $7,414 billion. I told you not to worry. Were any of you sweating it out? Because we've been somewhat plateauing. This isn't a huge increase. This isn't a huge increase from the prior week. This isn't a huge increase from the previous all-time high that we saw a month ago back in December of $7,404 billion. Just an increase of $10 billion. Again, Jay Powell could lose this as he's walking down Constitution Boulevard in Washington, D.C. $10 billion's chump change. But nonetheless, it is an all-time high. This, to me, is just the indication that it's going to continue going higher. We know where the debt levels are going. We know where the deficits are heading. That needs to be financed by somebody. And it's going to be financed, like it has been for the past year, by the Federal Reserve. So $7.4 trillion, don't be surprised by the end of the year if we're at $10 trillion or even higher than that. So again, some perspective as to what that means. $10 trillion would be 50% of U.S. GDP. That's a crime. That's a crime. But then you have to look at some of the other larger central banks like the ECB, which their balance sheet also hit an all-time high. They're now over 7 trillion euros. And that's an even bigger chunk of their GDP. Bank of Japan, same thing, same story. This is basically a complete takeover by central banks. And if markets only go up, then why do we need other banks? Why do we need investment firms? Why do we need money managers and financial advisors? You don't. If everything just goes up, what the hell do I need your opinion for? What do I need your quote-unquote expertise for? All I'm going to be doing is giving you my money to do something I could do because markets only go up. So these people better be careful as to what they're saying and what they wish for, because they're going to wish themselves right out of the job. Then with respect to M1 money stock, this is also hitting an all-time high, $6,798 billion. Again, were you worried? Because we were plateauing here and decreasing over the past couple of weeks. I'm not concerned about it. I'm concerned with the effects of what all of this means, but a week-to-week change, a couple weeks, that's not going to shake me in my boots. Almost $6.8 trillion, an all-time high. And as we continue with Nobody Cares Act 3.0, that's coming down the pike. Now, we don't know what the price tag of it's going to be, but it will come, and it will pass, and it will be in the hundreds of billions of dollars, perhaps over $1 trillion. Time will tell, but it is coming. Then there'll be some sort of infrastructure package, healthcare, environmental, just getting warmed up. And then to round it out, M2, money stock, you guessed it, also hitting another all-time high, $19,548 billion. This was a pretty big increase from the prior week, over $300 billion. Now, that was a doozy. Over $300 billion. The previous all-time high was back in the middle of December, $19,300 billion. So from that, a couple $100 billion higher. And there you have it. So, you graph and you chart money supply and global liquidity against global stock market. It's basically a one-to-one relationship. And it's not just correlation to me, it's causation. As I just previously stated, you take all of that liquidity away, these markets are nowhere near these levels. And these levels are at all-time highs on virtually every single metric, every single valuation method that is out there. It is in the 99th percentile or the 95th percentile. These are extremely dangerous levels. There was an interesting chart that was circulating around some of the people I follow on Twitter in the financial world that was showing how insiders within corporations are selling their shares at pretty much an all-time high, just getting out of Dodge, if you will. Meanwhile, retail investors have never been more bullish, because when you're looking at their ownership of stocks, single stocks, and maybe even more importantly and more concerning factor is the amount of options trading that's going on. So basically, retail investors basically say, screw it, I'm not getting enough bang for my buck just owning these shares outright. I want to go into the options, the derivatives market, and I want to buy a whole bunch of call options and just get the upside from that. And I imagine a lot of them are probably using margin to do so. So we have the rats abandoning ship within these corporations at an all-time high, and we have retail investors buying the market at all-time highs. So what does that sound like to you? Does that sound like a recipe for success, or does that sound more like something that's going to turn into a disaster in the not-too-distant future? Because this is the game, folks. This is the rinse-repeat cycle that they continue to play on us time and time again. Get the suckers in there. Juice this thing up one last time. Get that blow off top one more time. Maybe one more time after that if you can, depending on the mania. And it sure does help when Uncle Sam's throwing out, $2,000 checks here, $600 checks there, and you don't have to pay your rent, you don't have to pay your mortgage. You want food, go to a food bank. You got all this money, open up a Robinhood trading account. No fees, no commissions. Follow a whole bunch of idiots on social media that think, markets only go up, you can only make money. Sucker all these people into it. Never experienced a bear market. Have no idea what a bear market is. Have no idea what these valuations mean. Have no idea how to interpret a financial statement. What could possibly go wrong? And what this is going to do to these people psychologically, it's going to affect them perhaps for the rest of their lifetime. Markets are supposed to be here for us. It's supposed to be an opportunity to really grow wealth over the long term. This is just a casino, and the house wins. And these people, a lot of people are going to learn this the long way, the hard way, I should say. So you better understand what diversification means. You better understand what it means and how, I should say, how to read financial statements, what these valuation levels mean. Maybe it's better to be lucky than good. Maybe you can say that. Maybe it's, you got lucky with Tesla. Thank your lucky stars, start taking profits. Maybe you got lucky with Bitcoin. Thank your lucky stars, start taking some profits. Because we are in a mania. This is extremely dangerous. And again, most people don't care. Even if they knew this stuff, they probably wouldn't care because they're saying, well, I'm making money. And that's it. They don't care. They don't know. They don't understand what this means for the health and the sake of this country, for our body politic, for our broader economy, for society at large? Well, as long as I got mine, I don't care about you or you or you or the country or anything else for that matter. That's the casino. That's the jungle. That's not a constitutional republic. That's not free market capitalism. It's not. This is renegade. This is ridiculous. This is criminal. But this is where we are. And we continue to see 900,000 Americans filing for initial jobless claims. But as long as Tesla's up, Apple's up, Facebook's up, couldn't care less. And we'll continue to be in this environment, I imagine, for the foreseeable future. But markets are known to surprise us to the upside and to the downside. So as I say, stay diversified, stay vigilant, and stay with the Kapital News. I am Alex Karitis. Godspeed.